So money in banking, predominantly we're discussing money. And money is any item that is generally accepted as payment for goods and services, okay, and payment for debt. So money performs a lot of key functions, including store of value, medium of exchange, unit of account. It's also a standard of deferred payment. So quickly, there are different types of money. We have what we call commodity money, which has an intrinsic value like gold and silver. We have fiat money, which has no intrinsic value. It's backed up by a decree made by government, like the monies that we use. So we have bank money. These are balances held in banks and can be transferred via checks and electronic means. So characteristics of money are that money is what? Durable, portable, divisible, it has uniformity, limited supply, and acceptability. Okay. So we go to financial institutions and intermediaries. So there are different types of financial institutions and intermediaries. So different types of financial institutions. We have the central bank in Zambia, the Bank of Zambia. Also have commercial banks, development banks, insurance companies, and micro uh, financial institutions. So these play an important role in ensuring that there's what? Mediation between the savers and the borrowers. So the role that financial intermediaries play, number one, is to do what? To mobilize funds, to allocate capital efficiently, and to facilitate risk management. So financial intermediaries also improve liquidity in the economy. Go to the central bank. The central bank has a number of roles. So central bank is actually the apex in the financial institutions responsible for maintaining the monetary and financial stability. So what are the functions of the central bank? Number one, to ensure there's monetary policy implementation. So government plays two important roles. There's a fiscal policy and the monetary policy. The monetary policy is actually actualized through the central bank. The other function of the central bank is a currency issuance. So it is through the central bank that monies are issued. The central bank is known to be the lender of last resort. Maybe somebody to clarify, what does it mean when we say central bank is a lender of last resort?
It means commercial banks can lend from, this is where commercial banks go when they need to get loans.
Exactly. It is where commercial banks go to borrow when they need money. When they don't borrow from each other, they can borrow from the central bank. Okay, the other function of the central bank is that of maintaining price stability. So the central bank will keep inflation under control using the OMO system. It ensures that there's price stability and a stable environment to encourage what? Investment. So a central bank also has a function of regulation and supervision of banks. So it has to monitor and regulate commercial banks and other financial institutions to ensure that they operate in a very safe manner and they also protect depositors' interests. So central bank also manages foreign exchange reserves. So it is through the central bank that companies' forex is kept. It intervenes. It also ensures that currencies stabilize. All right. So it is through this function that exchange rates fluctuate. It also acts as a banker to the government because it maintains accounts for the bank for the government. So it facilitates what? Public debt issuance and also finance the deficits that government has to borrow through other instruments. All right. So what are the monetary policy goals? So monetary policy goals price stability to ensure that they control inflation. There's full employment so that they promote what? Creation of jobs and stimulating the economy. Economic growth. So it is there to facilitate sustainable economic growth and exchange rate stability. Like I said, it maintains the value of our domestic currency kwacha against foreign currencies. So what are some of the monetary policy tools that the the central bank uses. There are two main tools that the central bank uses. So these mechanisms that the central bank will use to regulate what? The money supply in terms of interest rates, in terms of credit availability. So these tools are broadly classified into two, the quantitative and qualitative instruments. So what do we mean by quantitative instruments? So the quantitative really focus on what? Uh, the volume of liquidity in the economy. So we use bank rate. So the bank rate is actually the interest rate at which the central bank will lend to commercial banks. Okay, so if they lower the bank rate to encourage borrowing and investment to increase what? Money supply in the economy. So you need to understand how the money moves in the economy. So when they increase the rates to discourage what? Excessive borrowing. It also uses the OMO system. OMO means open market operations. So using the buying and selling of securities like bonds. So by buying securities, it means government is injecting money into the system. When they're selling these securities, it means they're actually absorbing money from the system. So these are the systems that the central bank uses to control. The other are reserve ratio and statutory what? Liquidity ratio. So how does it use the reserve ratio and statutory uh, liquidity ratio? So the reserve ratio is the means through which uh, the central bank gives a certain proportion of how much uh, the banks should have as their minimum balance. Okay, so they have the reserve ratio, the less money in circulation. When they reduce the reserve ratio, it means there'll be more money in circulation. And we also have the statutory liquidity ratio, which is a percentage of the deposits that banks must maintain in form of liquid assets and cash or gold equivalents. So they adjust these to help in maintaining inflation. All right. Then we also have qualitative instruments. Qualitative instruments are aimed at controlling the direction and quality of credit rather than the volume. So we have what we call selective credit control, moral uh, suasion, and also directives. So these are what we call the qualitative instruments. So what is selective credit control? So selective credit control is one where the bank regulates credit to specific sectors. So they can restrict some loans, for instance, for speculative purposes. So they also encourage maybe productive sectors like agriculture if there are loans that are coming from SMEs. So this is speculative what? Selective credit control. Moral suasion is where the central bank will persuade or request commercial banks to follow certain policies voluntarily, like limiting credit to unproductive sectors. So those are moral suasion. Then directives are just mandates or instructions that the central bank will give to banks regarding the lending patterns, the interest rates, and priority sectors of financing. All right, are we together so far? So this OMO system,
Sorry,
the
Collins.
yes, there's a question.
That qualitative instruments,
Uh,
I would appreciate if you could just go a little bit deeper because I'm even shocked. It's the first time I'm seeing them, so I don't really understand them.
so I said there are two broad instruments that the Bank of Zambia uses. For the central bank, we have quantitative and qualitative. The quantitative are the ones that you've always been knowing. Okay. So we are now looking at the qualitative instruments. Okay, now what are these qualitative instruments and how are they used by um, the central bank? So just to simplify the version of what I talked about, so I said the qualitative are credit control instruments, which we also call selective credit controls. So these selective credit controls are adopted by the central bank to regulate the purpose and direction of credit rather than just its total volume. So it uses these tools to ensure that credit is used productively. Okay. We're not looking at volumes now. We're using maybe instructions. So these tools will ensure that what you're going to give instructions that will either boost a certain sector of the economy, okay, SME, agriculture, and also discourage credit to flow in certain sectors, no matter how profitable they are. So one of these qualitative is what we call selective credit control. So selective credit control is one that involves you targeting credit to certain specific sectors of the economy. So the purpose of this qualitative kind is to encourage lending only to productive sectors like agriculture, exports, and SMEs. On the other hand, you restrict lending to unproductive sectors like maybe the stock market, luxurious goods, So here the central bank may impose tighter rules to say loans for real estate speculation, you relax on that. Just focus on what agriculture. And there's what we call moral suasion, which is a softer approach where the central bank will appeal and persuade, please, commercial banks, act in this line because this is in line with our policies. They use verbal instructions. So this is non-mandatory, but they just persuade them to say, okay, for economy, how we are moving so much. So make it stricter. So they will use public statements, for instance, or policy guidelines to say, okay, our economy has been performing because people have been spending so much on alcohol and the like, and our health sector has been suffering, okay? So they hold meetings, commercial banks and executives, where they'll urge them to reduce lending on certain sectors and increase lending on others. So it's moral. They're making a moral persuasion. And the last one is a directive. Things become, they just make an official instruction to say, okay, this is binding. We have issued as a central bank that we need to lend in these sectors. So people must comply. They will give desired allocations that we need about 50% to go in this. They also give interest rate structure to say if you're going to lend to these ones, the interest rate structure will be so much. So the scope is this that they will lend to specific sectors and will predetermine the interest rates for priority sectors. So this one is a directive, a mandate that banks will use. All right. So the difference with this one is that for the other ones, we're using what volume. Almost the same. They'll just buy volumes of credit from the economy, or they will lend out so much money in circulation. So these are the differences that we have in the two. Are we together?
Okay, I just have one question just
Uh-huh.
to clarify this. Because from I think maybe the past in two past papers, I've seen him structure a question that says the direct and indirect tools. So would we then say the direct are the quantitative, or we would have to answer that differently? Because I've seen it state direct and indirect. I haven't seen the qualitative and quantitative.
Okay. So when the question comes to ask what are the direct and indirect tools that the central bank uses to control the economy, the direct tools, the indirect tools, okay, they talk about more on flexibility. The direct tools are more regulatory, they're more administrative. They directly influence the operations of commercial banks, like the cash reserve ratio, the statutory liquid ratio, the credit controls, selective credit controls. But when you're talking about indirect tools, we're looking at the tools that the central bank uses that are more flexible to influence money supply. And of them, there could be some of them that are still part of the what? Quantitative, like the OMO. The OMO is part of the indirect, where the bank will sell what? Will sell or buy securities in the open market. They'll also use a bank rate policy, which is a quantitative, but they'll use this to indirectly influence it. Okay, they're also part of the qualitative, like moral suasion, where the bank will persuade them. So it is in terms of flexibility, not in terms of whether it's qualitative or quantitative. I don't know whether
Okay.
is that clear?
Yes.
Yeah, so it's more in terms of flexibility than in yeah. Okay, so let me send you the inbox the types that you should look up for direct and indirect. So can we move? Okay,
Yes.
so also talked about the what expansionary and contractionary policies. So when we're talking about the expansionary monetary policy, we're looking at policies that are implemented during slowdown or recession to increase what? Money supply. So the tools that are used for expansionary are when you're lowering the current the reserve ratio, you're expanding. When you're buying securities, when you're reducing the bank rates. Okay, those are expansionary policies to expand on liquidity. Contractionally, you're constricting, you're controlling inflation by reducing money supply. So what are the uh, contractionary, the increasing reserve ratios when you're selling securities, when you're raising the bank rate? Those are part of the contractionary. Okay, are we together? Is that clear?
Yes.
Right. Let's go to money market and the capital market. So money market and capital markets, so these are both segments of the financial market, but they differ in terms of duration. So when dealing with the money market, we're looking at the short-term borrowing of less than a year. So these instruments will include treasury bills, commercial papers, and what? Core money. The characteristics of money market is that they have high liquidity, they have low returns, they have low risk, and they're used by government and financial institutions. Okay, and when dealing with capital markets, what is involved in capital markets, these are long-term for more than a year. These instruments include stocks, bonds, debentures, and the characteristics are that they facilitate capital formation and they have higher returns, and it's important in financing the infrastructure. So this is in the types of market. So interest rates and the Fisher's equation. So there are different types of interest rates that we must know. There's what we call nominal interest. So interest in generally is simply the cost of borrowing or saving. So we need to understand the distinction between nominal and real interest rates. It's very important for our critical analysis. So when dealing with nominal interest rate, is simply the interest rate without adjusting for inflation. So it is usually quoted by banks and financial markets, whereas real interest rates adjusted for inflation. So it's simply nominal minus inflation rate. Okay. Then we have what we call Fisher's equation. Any questions so far before I go? Are we together? We're following. All right. So when we go to Fisher's equation, it's important to know because some of the questions will ask you to compute and things. So Fisher's equation is given by the following formula. One minus nominal interest rate is equal to 1 plus the real interest rate in brackets 1 plus inflation rate. So this one helps investors and policymakers understand how inflation will affect the what? The real return on capital. Okay. So this is how we calculate that. Are we together? Unless any questions at this point? If, for instance, nominal interest rate is denoted by a small letter, maybe 10%, and you are told that inflation rate is what? 3%. So the real interest rate is 10% minus 3%, which is 7%. But sometimes will not give you the nominal interest rate, they'll give you the real interest rate, which is maybe 7%. How do you find the nominal interest rate? Because the real interest rate is after you deduct the nominal. So just add this back. So to get 7%. You get it? So it's just making something to from you. Okay, so we continue credit creation by commercial banks. So credit creation by commercial banks. So we know that the process of credit creation is through commercial banks. So how does the process of credit creation go about? So banks will accept deposits and will lend a portion of the money or keeping a reserve. So the cycle of increasing money supply is as follows. Okay. they receive money from savers, and a portion of the amount that is received from the savers is lent out, and a balance is kept in the reserve. So the limitations of how much money is circulated is dependent on the following: the reserve ratio, the demand for loans, economic conditions, and also the regulations that are there. So these are the determinants on how much money is circulated, right? So you must also understand the okay, any questions before I proceed? I need to cover all these units. I've summarized them in the smallest, quickest possible time. And proceed.
No questions.
I've talked about the process of what? Credit creation. Simply, the role that commercial banks will play in expanding the money supply. So the banks will accept what? The deposits from the public. The portion will be kept in reserves according to the stipulated reserve ratio, and excess will be lent out. So borrowers will spend the money in line with um, the recipient's deposits. So the cycle repeats itself. So now the limitations, I've talked about the reserve ratio and the statutory lending ratio, demand for loans, etc. So let's go now to exchange rate systems. So exchange rate systems have regimes. There's what we call the fixed exchange rate, floating exchange rate, and the managed float, or which is called the dirty float. So the fixed exchange rate, here the government or central bank will peg the domestic currency to another major currency like the US dollar to maintain a constant value. When you're dealing with a floating exchange rate, it is determined by the invisible hand of demand and supply without government having to intervene. The managed float is, it's also called the debt float, is a system where government generally floats in the market, but the central bank will occasionally intervene to stabilize the exchange rate, which had happened recently in Zambia. So currency movements. What are involved in currency movements? So we have depreciation, appreciation, devaluation, and revaluation. So what are those terms mean? So when you talk about depreciation, it's simply the fall in currency in the floating system. So the effect is that it will boost exports and will make them cheaper internationally. All right. So sometimes depreciation is bad for other nations. Appreciation is when there's a rise in value of the floating system. So here it will affect the imports. So the imports will be cheaper and will make and may reduce the exports competitiveness. Devaluation is simply when you have an official reduction in the currency's value in a fixed exchange rate. So revaluation, this is official increase in the value of the currency in a fixed system. So let's go to foreign exchange market. What happens in the foreign exchange market? We have participants like the central bank, commercial banks, forex brokers. Okay. So the key participants, the central bank is there to intervene to stabilize the currencies. The commercial banks will facilitate forex transactions, and we have forex brokers and dealers. These are intermediaries. We have multinational companies. So the common instruments that we have are spot contracts. These are immediate exchange of currencies, and we have forward contracts. These are agreements to exchange currencies at a future date. We have currency swaps. These are exchange of principal and interest payments in different currencies. So what are some of the determinants of exchange rates? We have the following determinants of exchange rates. Number one, we have inflation. We have interest rate differentials. So if you have a high interest rate, it would attract foreign capital and also lead to currency appreciation. The other one is inflation rate. The higher the inflation rate, the lower the purchasing currency. The other factors that affect exchange rates are current account balances. So if you have surpluses, they will strengthen the currencies. Deficits will weaken it. Political and economic stability. So if you have stable environments, will attract investment and will strengthen the currency. Speculation also, investors' expectations can also drive what? The currencies up or down. Okay, I'll send you the notes. I've already sent, some of you are already fully paid up. Then we go to the banking risks and management. So we have different types of risks in the banking system. So we have what we call credit risk. Okay, what is credit risk? It's a chance that the borrower will not pay. Liquidity risk is the inability to meet our short-term obligations. Interest rate risk is simply the loss due to mismatched interest. Then we have market risk, which arises from changes in the market variables like interest rates and exchange rates. We have operational risk. This is resulting from what? Internal failures or human errors. So how do we mitigate such risks? So risks are mitigated in many ways: through diversification, through asset liability management, through capital adequacy compliance, through internal control. So diversification is just spreading exposure to reduce what concentration of risk. Asset liability management, you're monitoring and aligning assets and liability profiles. Capital adequacy compliance, you are maintaining enough capital to absorb what the losses. Internal controls and audits, this is ongoing monitoring and evaluation. So what is asset liability management and what is involved in asset liability management? So by definition, asset liability management is simply what? What is asset liability management? Simply a strategic framework for managing interest rates, liquidity, and capital adequacy by aligning assets and liabilities in terms of maturity. So there are strategies that we use. There's what we call maturity matching, hedging, and interest rate gap analysis. So maturity is where we are aligning the timing of cash flows from assets and liabilities. Hedging, we're using financial instruments like interest rates and swaps to manage risks. And interest rate gap analysis, by examining the difference between the interest rate sensitive assets and liabilities. The gap analysis, we have a positive or negative gap analysis. So when assets reprice faster than liabilities, then we have a profitable rates rise. If we have negative gap analysis, means that liabilities reprice faster than assets, so meaning there are losses that occur when rates rise. Are we together? Okay. Then we go to the Basel Accords and capital adequacy. We have Basel I, Basel II, and Basel III. These you should be able to know and relate. So what do these entail? So in the framework developed by the Bank for International Settlements, BIS, they came up with these accords to promote global banking stability. So the features of Basel III, it has a minimum tier capital of about 6% of risk-weighted assets. Number two, it has capital conservation buffer of about 2.5 to be maintained during periods of economic stress. It also has liquidity leverage ratios of more than 3, at least 3% to limit excessive borrowing, and also liquidity coverage ratio, which ensures that there's enough high liquid assets to survive a 30-day crisis, and also a net stable funding ratio, which will promote a stable funding over a 1-year horizon. Then the capital adequacy ratio is used to measure the bank's relative risk to its weighted assets. So it is simply given by capital over risk weighted assets. Okay, so you can use tier 1 and tier 2 assets over the weighted times 100. We will see how questions come. So if you have a higher capital adequacy ratio, it means you have higher financial strength and ability to absorb losses. Let's now go to financial derivatives. What are financial derivatives and what are the functions and the types of financial derivatives? So financial derivatives are simply contracts that derive their value from overlaying assets like stocks and bonds and currencies. So types that we have are forward contracts, futures contracts, options, and swaps. So Forward contracts is a customized contracts traded over the counter. Futures contracts are stabilized contracts that are traded on organized exchanges. Options are what provide the right obligations to buy or sell at a certain price. Swaps are agreements to exchange cash flows, and the functions of derivatives are that they help in hedging to protect against adverse price movements. They also have a function of arbitrage, which is a profit from the difference across markets. And also speculation, they take positions based on the expected price and movements for the profits. So we will end here for now.